Hello, everyone. My name is Peter Kinkaide. I'm the CEO of Raintree Financial Solutions. I'm joined today by Greg Romundt, the CEO of Centurion Real Estate Investment Trust, or REIT. Good day, Greg. How are you?
Very well, thanks. Thanks for having me.
Absolutely. So, Greg, quick question to start off. You've been at this for quite some time with the Centurion REIT. What are you most proud of accomplishing over the last, I think it's 17 or 18 years now in total?
I have to say we've been, we've kind of picked our strategy early. We thought that apartments were kind of not an all-weather, but pretty close to all-weather type asset class. And that original thesis has proved correct. And we've, built an organization which puts us in one of the largest apartment owners in the country type category and delivered really solid returns with no negative quarters. And I think that's a tremendous accomplishment. We're very proud of that.
Can you quantify today where you're at? How many apartments do you own, asset size, that sort of thing?
So organizationally, we manage just under $3.5 billion. And that is, about just short of 11,000 apartments.
Wow. And so how has COVID-19 impacted your business over the last 6 months or so?
If you look at the financial statements, which will be published for Q2 in the next week or so, I think what you'll find is, unless we had mentioned it, you wouldn't have noticed it. And I think that really speaks to the strength of the apartment sector. Revenues were almost fully in line with what we would have otherwise expected. We held off on increasing rents to residents who were, in occupancy. So just like most of the large players in the industry did that. So did we, get the increases on those units? No, but we think that's a deferral, not a permanent loss in income. Occupancy was high. Collection rates were near perfect, not perfect, but we entered into some payment arrangements with some people. But still, if you look at the first month, which was the worst month, we're at 99.5% collections. So we think that is almost 100%, because even in normal times, we budget around 0.5% as an operating cost as a vacancy and bad debt.
And were operating costs affected? Did you have to do anything different to manage the properties through this period of time?
Certainly there's increased cleaning. We paid frontline staff more. I think what you'll find, though, which was kind of surprising, we took our net operating income ratios, or our NOI ratios, on our stabilized profits are actually up 2% year on year. Wow. So, to a record 70%. So, did very well. We paid our people well, and I thought that was the right thing to do, because they had to work harder than ever. It's not only did we not know the risks of being out in the front lines, they just had to spend more time, like cleaning and doing all those kind of things to keep the resident services up. So, we rewarded that, and I think it came back. The only other thing that we've noticed has changed materially as an operating cost really was insurance. And so insurance is becoming, it's made the news nationally, certainly in the condo sector, but almost every category of insurance has become more expensive. Although, on a $300 million of EBITDA, and a couple extra 100,000 of insurance costs doesn't actually move the needle that much, but it moved in percentage terms.
Is there a reason why insurance is escalating in price?
Well, I think there's a lot of uncertainty on the part of insurers about their risks to COVID exposure, right? So while it hasn't gone to courts or anything yet, there's certainly some states in the United States and around the world that are talking about whether COVID business interruption insurance, you could make claims. So I think there's a lot of hesitancy and a lot of reserve building because they just don't know. So and also the other thing that affects insurance rates is certainly very, very low levels of interest rates because they raise premiums to put into an investment portfolio. And if you can't get decent returns on your investments, well, that means you have to increase premiums. So those are the explanations that have been given to me.
Right. Now, historically, and I've always appreciated this about you, you've been very transparent about your outlook economically. Up until very recently, you had been calling for low interest rates for long, and quite frankly, it would seem that you were right on that call. But you've recently published a new sort of thought piece or document around how your thoughts are shifting moving forward. So can you just sort of comment on why is your outlook changing, and maybe just touch upon what you expect and how you might how that might impact Centurion REIT itself?
Sure. So my core thesis for the last 10 years has been basically disinflationary. Low interest rates, longer than anyone would expect. We wouldn't see outright deflation, but that we would, you know, have very low interest rates and a slow growth, slow growing economy. My view is that there has been so much debt that is going to get racked up in this process of recovering from COVID, and that the economic growth is going to be so poor because of lockdowns and the fear that politicians have engendered in the population, and then we're getting this reversal of globalization, and globalization was very deflationary, so its reverse should be inflationary. So you get all of these things put together, but the most significant thing is historically monetary policy has been a driver, and fiscal policy has been constrained by, I think, a budget discipline. And so politicians could feel like, oh, okay, even in Canada, this idea of a $30 billion deficit, you know, got a lot of people concerned. Now we're talking a $343 billion deficit in the first year, and Trudeau talks about reinventing our social, economic, power pulse, like everything. So this idea that we're going to have balanced budgets anywhere close to what we've historically gotten used to, it has been flipped on its head. So really what I'm suggesting is, I believe that governments around the world, this isn't limited to Canada, have been given a blank check by their central banks to print money, and that ultimately this is going to cause inflation, but may not necessarily create growth. So that means stagflation.
Right.
So it's a very long paper. Anyone who's interested, I'd suggest read it. It is a bit of a bear, but I've tried to make it readable.
Well, I thought it was great, and we've had a lot of feedback from people just commenting on how well thought out your thesis is. As it relates to multifamily, though, you know, in an inflationary period, you know, it's my thesis, but I'll leave it up to you.
Yeah.
How do you think inflation impacts multifamily, maybe in particular against other real estate asset classes, and then maybe asset classes overall?
Sure. So that's three separate questions. I would say apartments is almost in the sweet spot. Everyone needs to live somewhere. We saw, certainly in our business, and I think you would have a hard time finding another industry other than, you know, the mega cap tech companies, which did as well as Canadian apartments did. So I think that Canadian apartments are almost in a sweet spot. We have a shortage of apartments nationally. If anything, safe housing has gone up the national discussion, so very important. Inflation tends to be good for income generating asset classes. And the other thing is, which is very interesting, if you can raise money at less than the cost of inflation, in other words, raise money at negative real interest rates, well, that means for the first time certainly in my investing career, you can buy an income generating asset whose income goes up with roughly with the rate of inflation. and raise money at less than zero in real terms. So you could actually win on both sides of that trade. And I think that's an amazing opportunity. In terms of other sectors, sorry,
just to expand on that though, because I want to make sure everyone understands that point. When you talk about raising money at less than zero real rates, interest rates, you're talking about the bank financing that you're able to source, not the investors' capital that you're raising.
That's right. That's right.
But that spread is extraordinarily meaningful, even under these conditions, based on where cap rates are.
That's right. That's right. So, you know, today you can get 10-year fixed rate money at 1.5 to 1.8 kind of range. And if we think inflation is going to be 2, I don't think it's going to be 2. I think maybe over the next year it might be, but over a 5 or 10-year horizon, I think it's going to be a lot higher. And so you're, in real terms, you're borrowing at less than zero. Right. I think that's an unprecedented opportunity. And when we talk about other classes inside of real estate, in today's world, not all real estate is going to do the same. You know, retail, hotels, just been decimated. Seniors housing. I mean, it's going to be a really challenging business to be in any of those sectors. And even if you look at office, you know, I wrote a think piece on this about a month or 2 months ago, where, you know, my thesis was, look, even office is going to have real trouble, because yes, maybe the Bank of Montreal, who's your tenant, is not going to default on their rent, but when that lease comes up, do we need the same amount of space? And I really think almost every other sector other than residential is going to have maybe logistics industrial. Logistics industrial and multifamily only seem to be the sectors that do very well in a post-COVID environment. You know, we've always said that, you know, because people always ask me, oh, all real estate's the same. And I say, no, it's not. You know, it's not only a local business, but it's very sectoral. And I think, as I put out on my white paper, there's been no time, certainly in recent memory, that I can think of, that we have seen as large a divergence in performance of subsectors in real estate than we have today because of COVID. And I think that those are going to be long lasting, and they're not short term. We get past it and get a vaccine and it's all okay.
This has been great, Greg. I really appreciate your time today. For
pleasure.
anyone interested in learning more about this investment opportunity, we'll be hosting a webinar for you to join in on in mid-September. And if you're interested in reading Greg's white paper, please reach out to a Raintree private wealth advisor who will be more than happy to share that with you. Thank you very much.